Good evening, everyone. Thank you for having me to provide this introduction to the fund that I manage, JLEN Environmental Assets Group, or simply JLEN. So before we begin, I'll just draw your attention to the disclaimer. This presentation is to provide you with information on JLEN and is not intended to encourage you to rush out and buy shares. So I'm Chris Tanner, and I'm one of the co-lead managers of the JLEN fund. As it says here, I've been a partner of Foresight Group since 2019, and Foresight has been the investment manager for JLEN from the same time when it acquired the mandate and acquired the team to manage the fund. But my involvement goes much further back than that. I led the original IPO of JLEN in 2014 as part of the first generation of income-focused renewables funds that launched at that time. So slide 4, a bit more detail on Foresight Group. We are a sustainability-led alternative assets investment manager, and we have over 12 billion in assets under management. The large majority of those assets sit in the infrastructure part of the business, where my team and I are based. Since moving to Foresight, the benefits to JLEN have been clear. We joined when the fund had a market capitalization of 590 million and a portfolio of 28 assets, and we were a team of 15. The fund is now over 800 million, has 41 assets, and the original team is now backed up by Foresight's dedicated infrastructure division of more than 100 professionals, plus considerable support in other functions, including sustainability and finance. I'd like to highlight the origination and execution capacity of the Foresight team. We see over 500 opportunities a year within infrastructure, and for the most part, these all have some sustainability angle to them. We have the breadth and depth of resource that means we're able to get across all of these different sectors for JLEN and to focus only on those that we feel are the best fit. And some of those I'll talk about today. So JLEN is a diversified environmental infrastructure fund with a broad mandate that has to date taken in 10 different technology types, some of which generate renewable energy and some that do not, but have other environmental benefits. This includes wind, solar, anaerobic digestion, hydroelectricity, waste and wastewater facilities, bioenergy, low carbon transport, battery storage, and controlled environment projects. We are the most diversified fund by asset type within the renewable sector, and this diversification means that no one set of risks predominates. Something that affects a wind farm, for example, is unlikely to have an impact on waste processing. We target a sustainable and progressive dividend. At the current share price, the target dividend for the year gives a yield of just under 6%. And our portfolio has a high level of inflation linkage. When we look at the underlying revenue sources by type, 62% of those revenues on a lifetime basis are linked to RPI. And there's a slide later that expands on this, as I think the inflation linkage point is something that investors are very interested in. We are an Article 9 fund under the Sustainable Finance Disclosure Regulation. So that's also known as the deep green categorization. That means that we have to meet a higher standard regarding the sustainability of our portfolio. We put considerable effort into working out how to communicate the ESG credentials of the assets within the fund, and that's something that we'll return to as well later in the presentation. So our investment strategy is to target infrastructure assets and more recently asset-heavy businesses with infrastructure characteristics that support more environmentally friendly approaches to economic activity, that support the transition to a low carbon economy, or that mitigate the effects of climate change. So far, our investment strategy has taken us into renewable energy technologies, including a range of intermittent and baseload generators, and it's also taken us into wider environmental infra assets, such as waste processing, low carbon transport, and controlled environment deals. We're also seeing increased opportunities in the byproducts or waste outputs from our projects. Our Cramlington biomass power plant, for example, is able to sell otherwise waste heat to nearby businesses. Our recent investment into a controlled environment glasshouse is located next to one of our anaerobic digesters because of the synergies that exist between the two. And our biocollectors food waste business powers its own collection trucks with biomethane that is produced from the food waste. So these are all illustrative of the way in which societies will need to think about resources in the future and to manage them as efficiently as possible in order to thrive sustainably. Our investment policy is intended to facilitate following these trends where good investment opportunities emerge. This slide shows how the fund has developed since IPO. We started in 2014 with 8 assets in wind, solar, and waste processing. Now, we made our last investment to date in wind and solar in 2017. We still think that these make good long-term investments, but competition in these markets has meant that we felt that we could find better risk-adjusted returns in other sectors. For example, we made our first investment into anaerobic digestion also in 2017, and we've gone on to hold one of the largest and best performing portfolios of AD assets in the market. And since then, we've continued to invest in environmental infrastructure where we perceive value, including battery storage, biomass combined heat and power, and low carbon transport. We have 41 assets that we group into 7 technology sectors. Slide 8 is another way of looking at the development of the fund across different metrics and comes with the disclaimer that past performance is no guarantee of the future. I'll just pick out dividends. We are primarily an income-paying fund, and we've paid a growing and fully covered dividend to shareholders for each of the last 8 years. So this slide shows where our assets are. It is a very UK-focused portfolio. So as at the 31st of March, 96% of the portfolio by value was located in the UK. We do have some European assets, including an energy from waste plant in Italy and interests in wind and solar assets in Scandinavia and Spain, respectively. Foresight has overseas offices in several key markets. And so I think it's likely that we will see further overseas investment, but the portfolio will remain heavily UK focused for the foreseeable future. It's also very substantially a portfolio of operating assets. Now, we are able to invest in construction stage assets up to 25% of NAV, but at 31st of March, only 2% of the portfolio was classed as being in construction. Since then, we've added some further construction assets where we feel comfortable with the risk, and these typically offer higher returns and should add value as they come out of construction successfully and enter operations. Slide 10 shows how we expect the revenue mix of the existing portfolio to change over time, and it also talks to inflation linkage. If we consider the underlying revenues earned by our assets, we can see that the largest proportion is categorized as subsidy revenue. So that's the blue chunk at the bottom. These are the subsidies that are earned by our renewables assets, and they are fixed price in nature, and they increase annually by RPI. We also have revenues from concession-based projects that have long-term contracts with public sector clients. These contracts also have payments that are linked to RPI, and you can see them there in the green. When we add these two up over the life of the portfolio on a net present value basis, we get to 62% of portfolio revenues being fixed price in nature and having explicit linkage to RPI. So that is a very attractive feature in the current market. Our other revenues are typically shorter term arrangements that don't feature the same explicit linkage to inflation, but where we can increase the price over time as we renew the arrangements. And of course, we have 29% of revenues from the sale of electricity and biomethane on wholesale markets. Here, our revenues move as the market moves. So currently, wholesale revenues are very strong, as people are aware, If we go back to COVID times, they were far weaker. So, we go through a cycle with wholesale revenues. So we are a sustainability-led fund, as befits our Article 9 status, and proud of the contributions our portfolio makes across a wide variety of metrics, as you can see on this slide. To select a few, we've treated over 35 billion litres of wastewater. So that is enough to fill 16 Millennium Domes turned upside down. And we've recycled 135,000 tonnes of waste. So that's the same as the annual waste collected from 340,000 households. Almost 500,000 tonnes of organic fertiliser created by our AD plants is being spread to farmland. And this offsets the use of chemical alternatives, providing a more affordable and sustainable solution for our farming partners. JLEN has adopted and actively promoted ESG for several years. We produced our first ESG report in 2019, and we continue to progress in this area with a dedicated ESG committee of the board recently set up to oversee the work done. And this year, we've also included our first recommended disclosure under the Task Force on Climate-Related Finance Disclosures, or TCFD, and we also mapped the portfolio against the UN's Sustainable Development Goals. We work hard on communicating our approach to ESG matters, and that's why it's fantastic that we've been recognised by the Association of Investment Companies, winning the Best Communication of ESG award in their annual communication awards. And that's just one of the awards and commendations that we've received for our ESG approach. Now, the next few slides give an overview of some of the assets within the portfolio. So we'll start with a wind farm. So this is the predominant renewable technology in the UK. A wind farm captures the kinetic energy present in the wind resource and converts it into electrical energy. We describe the wind resource as an intermittent resource. It's not available to generate electricity all the time. The wind farm is connected to the electricity grid, and the electricity exported is metered. That metered electricity in kilowatt hours is sold to an electricity supplier via a power purchase agreement, or PPA. And that metering also determines the subsidy that we receive. That PPA requires the supplier to purchase the generator's electricity at an agreed price, which could be a fixed price, but is more usually a price that floats according to a specified price index. The PPA will also govern the transfer of the green subsidy benefits. In the case of JLEN's wind farms, these are known as ROCs, to the generator in return for money. The electricity supplier then supplies the electricity to consumers. Recently, interest from both consumers and corporates in purchasing electricity from renewable generators has opened up an additional revenue area for renewables assets as we sell green electricity and green gas certificates to people wanting to demonstrate their green credentials. Wind is a very established technology and considered to be low risk. It also has a reasonable level of subsidy support in the case of wind farms within the JLEN portfolio. So just under half of the revenues of a typical wind farm come from ROCs. And as I just explained, this is a long-term fixed price and RPI-linked revenue stream. So let's compare this to a food waste plant using anaerobic digestion to convert food waste into either biomethane, sometimes known as green gas, or electricity. So food waste is brought to the plant. Often it will be pre-treated to make for a more homogeneous material going into the plant, which improves the process. And this food waste, so it's an organic feedstock, is then broken down by bacteria in the digester in an oxygen-starved environment. As the bacteria break down the organic matter, they produce a biogas that's rich in methane. What happens to this biogas is determined by whether the plant is a gas to electric plant or a gas to grid plant. In the first case, the biogas is combusted in a gas engine and electricity generated and exported to the electricity grid. In the second case, gas to grid, which makes up the majority of the AD assets within the portfolio, the biogas is passed through an upgrading unit where it's brought up to the standard that is sufficient for the GB gas network. At this point, the gas molecules are practically indistinguishable from fossil natural gas and mixes with it in the gas network. So about 1% of gas volumes in the GB network are biomethane from AD plants. For a gas to electric plant, the subsidies are feed-in tariffs. For gas to grid assets, the subsidy is the renewable heat incentive, intended to incentivize generators of renewable heat. The RHI is very similar to ROCs and feed-in tariffs in terms of subsidy structure, lasting for 20 years and having the same RPI linkage. What's different is the proportion of subsidy to merchant gas revenues. So round about 75 to 80% of revenues typically come from the subsidy. So that is fixed price and linked to RPI. Significantly higher than is the case for wind and solar. And when you consider that we generally see higher returns in this market than for more core renewables, then this becomes very interesting to us. And the final case study is for our investment into refueling stations for gas-powered compressed natural gas heavy goods vehicles. Our stations provide a biomethane product, so gas that comes ultimately from AD plants such as our own, and this provides a significant emissions saving compared to the diesel truck equivalent, about 85% lower emissions on a well-to-wheel basis. Here, we provide refueling services to major fleet customers like Amazon, Waitrose, and Royal Mail. As they refuel their trucks at our stations, we bill them under contract for the commodity gas price and also a compression margin that reflects our costs of providing them with biomethane in a compressed natural gas form. So crucially then, we're not exposed to the current high price of natural gas. This is passed through to the customer. And this is an example of an asset in the portfolio where we have an operating partner that also has financial interests in the business. We structure these deals to protect our base case returns, receiving returns in priority until a hurdle rate is achieved, and then sharing upside with our partner above that level. So hopefully those three examples gives you a feel for some of the assets within the portfolio. So we now have a couple of slides on the market, the outlook, and JLEN's near-term pipeline. We've illustrated here how we view the market with this double pie chart. Around the outer ring, we have the main market drivers relating to the energy transition, informed by some of the pledges made last year at COP26. Certainly, in the opening addresses of COP27, the message is very much of honouring these pledges and underlining the benefits of clean growth. Whilst these four drivers are quite straightforward to relate to when we discuss decarbonisation and the pathway to net zero, in practice, it is much more complex than this. In the inner circle, we've stated some of the other aspects that should be equally considered when determining investment opportunities for a sustainable future. So we shouldn't gloss over the impact that issues like food security, waste and water management can have on curbing greenhouse gas emissions, nor the importance and benefits of nature recovery in our business decisions through actively restoring and improving natural assets. Indeed, Foresight just last week launched their nature recovery statement alongside our new sustainability partner, the Eden Project. And with JLEN, we now have biodiversity plans on many of our assets and are looking to roll these out further. I think we all recognise that new green technologies such as electric vehicles, long duration storage and carbon capture, to name just a few, will play an increasingly important role in our pathway to net zero. And if we take the recent World Energy Outlook report from the International Energy Association, they provided an updated roadmap to net zero emissions by 2050. And they're clear that decarbonising the energy system begins with changes in demand. The contribution that solar and wind play in offsetting the demand for fossil fuels is key. Our change in habits and use of new technology, such as electric vehicles, help this transition, as does energy efficiency in buildings and industry. However, we should equally recognise the challenges in addressing the production and supply of materials for many of these technologies. Investment opportunities into new green technologies could, for example, take the form of electrolyzers for hydrogen projects. So it's certainly an exciting time for an environmental infrastructure fund such as JLEN, with a broad investment policy that places it in a strong position to capture opportunities in these evolving asset classes. And on this slide, we've categorized our near-term pipeline across the features that we look for in environmental infrastructure. So aquaculture, the growing of fish protein in a controlled environment facility like our Rjukan facility in Norway, can play a role in mitigating the effects of climate change through managing water stress. We believe the market presence and knowledge that we've built up through the Rjukan project will place us well for further investments in this sector, alongside other controlled environment assets, such as vertical farms that help manage land use change. Bioenergy remains a key part of our portfolio and our pipeline through additional biomass and energy from waste opportunities, including monitoring the rapid advancement of waste to fuels technologies. We also feel that there is greater consolidation to come in the market for biogas, not only in the production assets themselves, but thinking about how we can make those businesses more resilient through acquiring the companies that supply their feedstock. And we recognise the role that battery storage continues to play in our energy transition. Whilst this market has matured rapidly and competition for these assets is stronger than ever, we believe some limited further additions, particularly with near-term grid connections and in other geographic locations to our current portfolio, will have strong cases to make. We also believe that hydrogen will become an attractive investment sector for JLEN over the short term, and with current opportunities more development, in the development stage, this is an area where we're likely to use the small part of the fund that we're able to put into development stage activities. And lastly, low carbon forms of transport contribute to economic activity in a sustainable way. So we are looking to roll out additional CNG refueling stations over the course of the next 12 months. And we're also evaluating businesses in the UK and Europe that have an approach to EV charging infrastructure that we think fits the fund. So we are more interested in supporting charging at homes and apartments where we feel the demand will be greatest. So overall, the pipeline is healthy, and it follows our theme of diversification through disciplined assessments and that of investing in assets and asset-backed companies that support a more sustainable economy. So this slide sets out the key terms for JLEN. I'll just draw your attention to the simple fee structure. So there are no performance fees, no origination fees, and at the size that JLEN is now, above a market cap of 500 million, it is 80 basis points as the portfolio grows. And so, in summary, JLEN is a broad environmental infrastructure fund, and our mandate provides the differentiation within a sector in that it allows us to construct a portfolio that is more diversified and where we can assess a wider opportunity set. We have good income characteristics and attractive inflation linkage. We have strong ESG credentials, and we work hard to communicate what we do to investors. And we're extremely well placed to capitalize on growth in environmental infrastructure as the world seeks new solutions to providing the essential services and facilities that populations need in a sustainable fashion. So that concludes my remarks now. I'll hand back.
Excellent. Well, let's thank you so much, and let's move on with the questions, because there's quite a few of them coming through already. So straight at the top here, there's one about, could you provide an outlook on the net asset value given inflation, wholesale prices, but also the increases in discount rates?
So I'm afraid the simple answer is no in this forum, but we will be releasing our half-year results on the 28th of November. But the question asker is quite right to point to a number of factors that are moving in different directions. So yes, we recognise that discount rates are likely to increase, and indeed a number of our peer funds have increased discount rates as a reaction to the rising cost of government gilts in particular. Set against that, power prices are high at the moment, although there is an expectation that government will tax some of those higher revenues in some manner. And also inflation is very high. And as I touched on in the presentation, the portfolio has very good RPI linkage in particular.
Excellent. And as you can probably imagine, there's also a whole swathe of questions here about the regulatory environment, and I think they're probably worth taking as sort of separate questions.
Sure.
So number one's come through about the windfall tax, and there's an awful lot, of course, in the newspapers about this being now extended to electricity producers. That in its own right is an issue, but it also suggests that maybe this is something that Whitehall has become. Now they've done it once, they're becoming a little quicker to do it again. I guess specifically, are you affected by that being extended to electricity producers?
So the simple answer is that yes. We expect that government has signalled that they anticipate taking some share of the profits that electricity generators are making at the moment in this time of higher energy prices. There are two things that we're hearing at the moment. So the first is the Truss government introduced legislation around a revenue cap before Parliament. And that, as I understand it, is still before Parliament. We're also picking up signs that actually the current administration prefers a windfall tax that is more akin to the tax that was applied to oil and gas producers in the North Sea earlier in the year. What we can say, though, is that if it turns out to be a revenue cap, the expectation there was that would apply to rock assets in particular. And when we look at our portfolio, only about 50% of the portfolio are supported under the rock regime. So the other part of the portfolio would not be captured by that particular revenue cap.
And is that because of any linkage with? Because I know the European Union now has a revenue cap, if I'm not mistaken. Is it because it would almost be a direct lift of that, or is that unrelated? These are all just what I think is happening. I don't know what is happening. So I think the Truss government sort of zoned in on a revenue cap, largely because it had declared that they were against windfall taxes. And so they were trying to present a revenue cap as being not a windfall tax. I think, to my mind, to most people's minds, it's just a tax in another, in just another way. But that's what they seem to favour. If it turns out to be a windfall tax on electricity generation, then we have, again, around about 50% of the book that isn't involved in electricity generation. We have gas assets and we have assets that have no renewable power aspect at all. So again, those assets wouldn't be caught And I think this is one of the advantages of the diversification that we have within the portfolio. Not all of our assets will be treated the same, and some of them will not be caught by any government intervention.
Excellent. And then there's also a question about, is it the CFDs, so the contracts for difference, which at the moment is a way of kind of guaranteeing a certain price.
Yeah.
As I understand, they've worked quite well. How confident are you that sort of setup will continue?
So the existing framework for CFDs, I am very confident indeed that will continue. That is doing exactly what it's supposed to do. It is driving down the cost, particularly of things like offshore wind. And the UK has one of the best offshore wind resources in the world. And indeed, consumers are benefiting now from the low CFD prices achieved through that subsidy structure. If the question, though, is more aimed at whether a CFD will come in for existing renewables that are currently under different subsidy regimes, the answer is I don't know, but it's certainly being mooted. And I think the rationale is quite sort of straightforward to understand. If it's the case that government expects to take upside revenues, then it's reasonable to expect government to protect generators when they suffer from downside scenarios. And there's a kind of quid pro quo there. So I think there's a reasonable chance that will come in. And obviously, if it does come in, and we choose to switch some of our assets to that regime, I would expect discount rates to lower to reflect the lower risk that we then face. We've effectively taken ourselves away from market risk.
Mm-hmm. And I know obviously JLEN is reasonably, your FTSE 250, aren't you? I think it's large, in terms of a sort of a mainstream investment fund. But I'm wondering, do you also have a size advantage? Because when you look at some of the investors out there in this kind of stuff, it's often sort of sovereign wealth funds, etc. I can imagine that maybe some of the questions you're looking at, some of the investments you're looking at, might fall below their radar purely because they're not big enough for them to consider.
Yes.
Am I right in thinking that there's always you're able to be more agile than some of the big investors out there?
Yes. You
are some of the major investors.
If you look at things like offshore wind, these are investments that run into the billions of pounds, and we are not looking at investments in that space. For example, even if we were to be able to buy a stake, we would be a very minority investor, and what we like is to have active management where we can make a difference to the assets that we own. And that's certainly been the case in parts of the portfolio, like the anaerobic digestion assets, for example, where we've been able to do things like expand their capacity. So one of our assets there, the Vulcan plant, we bought it generating gas at the rate of 450 cubic meters an hour. It now generates gas at over 1,200 cubic meters an hour. So that's a very substantial increase and a substantial value uplift as well.
And there's some more forward-looking questions here. Now, I know you just said you don't potentially go into those big multi-billion projects where you've got less of a say, but someone's asked about your view on deep offshore, the offshore floating wind. And I know this is something, it's something you hear about from companies like Shell. And, for anyone that's watching is not familiar with this, it's the idea the next generation of wind is going to be much further out to sea, floating in the Atlantic. Is that something you're enthusiastic about? Because it sounds like a lot of people are in general in the city.
It's certainly something that, as Foresight, we are keeping an eye on and looking for suitable opportunities. For JLEN, I think I would prefer to see the technology deployed and working at scale. But then, it may well be suitable for JLEN.
Excellent. And a question here, perhaps very specific one, but perhaps you'll be able to give some insight. This is the dividend increasing in line with inflation? Nice optimistic question there.
So no, our policy is not inflation-linked dividends, but we do aim to provide a progressive dividend, and that is what we've done to date.
Mm-hmm. Absolutely, and you've also outlined the ways in which you're perhaps less disadvantaged than some of the other options out there by those trends. So hopefully that'll have given. I know that question came through quite early on, so hopefully some of the other stuff you've touched on will have given them a bit of indirect insight into that. Well, excellent. Thank you so much for that presentation, Chris. That was, again, really, really brilliant. A couple of people commented just to praise how useful they found that one. So thank you again for joining us.